Federal Reserve Chair Janet Yellen testifying on Capitol Hill Wednesday, telling lawmakers a 2015 rate hike is likely. For more analysis on what all of this means for the markets, I'm joined on set by Liz Ann Sonders, the Chief Investment Strategist at Charles Schwab. And Liz Ann, it's great to see you. Welcome back.
Thanks very much. Thanks for having me.
So nothing too new from Yellen's speech, but when do you think the Fed will raise interest rates?
And the fact that there's nothing new is pretty much her MO. She doesn't tend to use speeches like this to give tremendous new color. Our best bet is still September. Now, there's been some weakening in the economic data. Were that to continue and global events were to stay tumultuous, then maybe you push that out, but that's our best guess at this point.
And she also said investors shouldn't obsess over the first rate increase and instead focus on the overall pace of rate hikes. But how will the markets react to that first increase and the subsequent ones?
So I think the first increase will be priced in. It maybe already is priced in. I don't think the market is going to be surprised when the Fed makes its initial announcement. And I completely agree with her message to the markets about it's not necessarily the timing of the first hike, but what the path looks like thereafter. And the potential good news is she's been very transparent in suggesting this will be a slow cycle. And slow cycles historically have been met with much better market returns than fast cycles. And I think that's important for investors to consider.
All right, but with rates so low for so long, I mean, do you think the Fed could ever get back to a 4 to 6% Fed funds rate, which is where it was before the recession? I mean, is the Fed creating a new normal where even if we raise rates, they're still going to be very low?
Could they ever get back there? Sure. In the near to medium term, no. And whether it's a new normal in perpetuity is a separate question. But I think it's a new normal in the meantime because inflation is so low, disinflationary pressures remain, and therefore to expect Fed funds rate to go up much beyond a few hikes, at least in the near term, I think is a stretch.
All right, investors are so fixated on this first rate hike, but once they do pull the trigger, I mean, can the markets get back to an earnings-driven equity market? I mean, isn't that what should be driving markets, not Janet Yellen?
I think not only can the market get back there, but I am in the camp that believes that when the Fed starts to move policy towards something akin to normal, that may be a release valve for some confidence. Because I think many view, whether it's business leaders, investors, view the Fed as still treating the economic patient like it's in the trauma room. And I think a message coming from the Fed that we view the economy as on some sort of self-sustaining path may actually release some of this pent-up demand, and I think would be a good thing for the economy.
All right, now just real quick, where are you putting money to work right now amid rising rates? I mean, should investors be focusing on some of the financial sectors out there and staying away from the capital-intensive, rate-sensitive sectors like utilities and telecoms?
Yeah, so we are neutral in terms of the overall U.S. equity market, but our two sector recommendations on the buy side are technology and financials. And financials is a function of both valuation, but also the view that rates will start to go up. And to your point, telecom and utilities, which are our two underperformed recommendations, are clearly on the more defensive end of the spectrum. So a cyclical bias in our sector recommendations.
All right, Liz Ann, we'll leave it there. Liz Ann Sonders, the Chief Investment Strategist at Charles Schwab. Thanks very much for being with us.
My pleasure.
I'm Scott Gamm, and you're watching The Street.